We are looking at the market open here as stocks are struggling a little bit, though basically around the flat line, potentially waiting for the next catalyst for the day. This comes after the S&P closed Monday with its best day since early June. Nvidia was one of the stocks leading the index higher. Now it is ticking lower, down just nearly 0.2%. Our next guest says, though, that the hype around names like Nvidia could push the S&P to even bigger highs in the next year. Joining us now is Neil Shearing, Capital Economics Group Chief Economist. Neil, it's great to have you. Thanks so much for joining us here. So I know you recently changed your call on where you see the S&P heading. Talk to me about what that call change was and what inspired that change.
Yeah, well, the roots of our call on the S&P go back several quarters, actually. We did a large piece of work at Capital Economics looking at the effects, both economic and market, of the AI revolution. The conclusion of that was that we thought it would have a positive impact on economic growth. But normally what happens during these big breakthrough technologies is that markets try to capture the benefits of that growth ahead of them actually crystallizing in the real economy. So you tend to get hype, you tend to get bubbles forming. We obviously had that in the dotcom boom. And our sense is that the same thing is playing out with AI. And so there's a debate about whether or not we're in an AI bubble. How far does that have to inflate? If you look at history, it has a lot further to inflate. Hence our view that the S&P 500 is going all the way to 7,000 potentially by the end of next year.
Neil, talk to us a little bit more about that, because we've gotten a lot of pushback when we have asked other strategists and even economists about whether or not we are seeing any signs that are similar to what we saw during the dot-com move. And they bring up valuations and how there's a huge gap here, similar to what you were just saying. So obviously, a lot of your call has to do with the fact that the S&P is going to go all the way to 7,000. But I guess what's going to be the catalyst then? Is it just going to be the same hype here that we're seeing play out today? Are we going to start to see maybe more participation beyond the handful of tech names that have really been riding this AI wave, and that's going to then contribute to this bubble concern?
Yes, I mean, I think when you look at the differences and similarities between now and the dot-com boom, there's a couple of important differences. The most important one, I think, is the fact that a lot of the hype and actually revenues generated by the AI boom have been in established listed companies. Hence, we have the Magnificent Seven. Whereas in the dot-com boom, a lot of it was about small, scrappy startups where the technology was being developed. So we've got large listed companies developing this technology, and actually it's generating revenue as well. I mean, these companies are highly profitable with huge margins. So I don't think this is necessarily all a bubble, but our point is that we have seen margin expansion. I think we're going to see further margin expansion from here as hype tends to build, and most bubbles need a narrative. Robert Shiller's been very good on this, the idea of narrative economics, and we have a narrative around AI. So there's a grain of truth in all of this, that these companies are profitable, they're generating large revenues, but there's a narrative building around AI that will continue to build, that will continue to inflate a bubble. So you look for a catalyst. I think we have the catalyst, we've got the narrative, it's just will continue to inflate.
What's going to cause it to pop then, Neil? When we talk about the fact that it's going to peak at 7,000, what's going to trigger that to then and the potential fallout that we could see?
Exactly. This is the big question. How far does it go? When does it peak? What causes it to pop? All of those questions are incredibly difficult to answer. We can start to think about how far it might inflate by looking at things like what do we think the future path of earnings in these companies might be, and what tends to happen to earnings multiples during bubbles, and that can anchor a view as to how far this bubble might inflate. I should say that when we first developed this view, we said we thought the S&P 500 might go to 5,500 in 2024, and we spent the rest of the month kind of this is about 12, 18 months ago, fielding calls from clients saying, surely you can't be serious. So there has a habit, these things have a habit of building quite quickly and in ways that you don't necessarily think are plausible at the time. So that gets you to 7,000. I think you can kind of root your how far does it go in a view about what happens to earnings and what happens to earnings multiples. The question is, when does it get there, and then what causes it to pop? That's much more difficult to to answer. On the current trajectory, I think it's probably got another 18 months, 2 years, if you look at the kind of lifetime of bubbles and how long they take to inflate. And then what causes it to pop? It can be a whole manner of things. It can be big corporate default. It can be earnings misses. It can be a company that seems to be at the vanguard of this revolution experiencing trouble, or it can be a good old-fashioned economic downturn that causes bubbles to pop. I think at this stage, it's still a bit early to say what might cause that.
In one of your recent notes, Neil, you talk about how we must surely be somewhere close to the peak of inflated expectations, which suggests that we'll go through some skepticism before reaching peak pessimism and then a bit of a recovery. I'm curious if you can talk about what the timeline will look like before we get to that pessimism starting to sneak in and how earnings plays into that. I know you were just talking to that point a little bit, but these earnings expectations are so high. I wonder if that means that the pessimism is going to start to creep in a little earlier for these AI names.
I think there might be something to that. And actually, I think there are 2 points here. One is about the kind of hype and optimism, and then pessimism, skepticism about the impact of AI in the real economy, its impact on productivity growth and economic growth. And the other is the impact of the hype and then the pessimism around the impact of AI on particular firms at the vanguard of this technology. So as I say, we've started to see these firms being incredibly profitable and generating vast revenues on the back of AI technology already. We're not yet seeing that translate into productivity growth in the real economy and optimism about broader benefits of AI for the real economy, and that translating into GDP numbers and productivity numbers. It gets you back to Bob Solo's famous point about we see the computer age everywhere apart from the productivity numbers. Well, it's kind of true in the AI revolution, right? We see the AI revolution everywhere. Everyone's talking about ChatGPT and NVIDIA, but we're not really seeing it yet in the productivity numbers. So I think there's a cycle of optimism and pessimism around the real economy before we find a steady state. But the same is true around the markets and the market implications of the AI revolution. And I think those two things are not necessarily moving at the same speeds and at the same time.